안녕하십니까. 한국경제신문 뉴욕 특파원 박신영입니다. 오늘은 UBS의 수석이코노미스트 조너선 핑글 씨와의 인터뷰를 통해 미국 관세, 인플레이션, 그리고 국채시장 등 다양한 의견을 들어보도록 하겠습니다.
Our Koreans are really interested in U.S. economy, including especially in tariff. These days, people are talking about the risk of slowdown because of tariff. But so far, the actual data doesn't show much weakening or a real recession. For example, hard data and soft data seem to tell different stories. So which one should we focus more?
I mean, the soft data since COVID has been difficult to follow. I mean, it's had periods where it looked very weak, like during the Fed's rapid interest rate increases. So sometimes the soft data can be leading, but not all the time. In this case, though, I do think that we're eventually going to see some of the impact in the hard data. We have seen increases in layoff announcements. We can measure that. Also, if we look at things like the data on orders for, say, equipment or business investment, that data actually had suggested that in the fourth quarter, the animal spirits and optimism were rising, and businesses were increasing their orders of equipment, technology, et cetera, all indicating better investment. Now, since January, those orders have turned around and started to decline. So we are seeing on the edge. It's not big, it's not necessarily weak, but we are seeing some signs that the initial positive growth impetus that we were watching at the turn of the year is starting to fade somewhat. And we also have to realize that there's a lag with the hard data. So a lot of the hard data we're getting now is still from March, which was before the tariff announcements. And those tariff announcements, I think, were much larger than most of us, including myself, had in mind. So I think we're still waiting to sort of understand what's going to happen. We also have seen some pull forward. For example, auto and truck sales in March were very strong. That could have been people, say, getting ahead of potential tariff-related price increases. So some of that might also have been helping the hard data in the first quarter. But we've seen consumer spending slow a little bit, and I think that as we get more and more data, as the tariffs take hold, I do think the economy is going to show more obvious signs of slowing.
I'm not expecting hard data is weakening or worsen, but when can we see the hard data is weakening?
You're already seeing a little bit of it, but I do think that you'll see the April data that's released next month in May on business investment will show more weakening. And then I think, we are expecting a little bit softer employment report on Friday for the April employment report than in May. Now, we're not expecting a bad employment report, but, a little bit of slowing. But I think the labor market data is probably going to lag what's happening. But I think that data will probably look weaker in sort of June, July, and August. So I do think there's some parts of the economy that have been relatively strong coming into the tariff announcements. So I think it might take a few months for those sectors to really feel the impact. But I think we're going to start to see, maybe not this month, maybe not in the next few weeks, but I do think that we're going to start to see weaker hard data by the time we get to this summer.
Actually, for example, a Korean company is worried about uncertainty more than tariff itself. Because, for example, they are making version 100 because of Trump administration changes tariff policy so a lot. There is still a lot of uncertainty caused by tariff. And how could this uncertainty affect the economy? And how much do you think it could lower U.S. GDP growth?
Uncertainty is something that can weigh on growth and business plans. We've certainly seen it before in the United States. There was some very nice academic research done around the time of the expiration of the Bush tax cuts in 2011 and 2012 that showed very clearly that businesses were postponing investment decisions because they were uncertain about what would happen to business taxes at that time. And we expect something similar maybe unfolding now. I mean, it's hard to put a point estimate on the impact, but even when we were publishing back in November, so coming into this year, we were expecting the economy to slow a little, in part because we thought there would be uncertainty around trade. And with the expiration of the Trump tax cuts at the end of this year, we also thought there would be some uncertainty around tax policy. But with both trade and tax policy somewhat uncertain, we were expecting that 2025 would have, somewhat weak investment. Now, I think what we're going through is worse than we expected. So I do think this is going to cause, business investment to decline. But business investment was reasonably strong in the first quarter. I think it's probably going to be weaker in the second quarter. But I think the big impact is probably going to show up sort of this summer and fall in the second half of the year. But we know from the academic research and historical experience that high uncertainty can negatively impact growth.
How do you predict US GDP growth in this year?
Well, coming into this year, we thought real GDP growth would be about 1.75%. We were seeing some signs of slowing in consumer spending. Some of the fiscal policies that had been supportive of growth during the Biden administration were going away. So we thought that this was an economy that was sort of slowing closer to trend growth in 2025. After the tariff announcements, we were surprised at the size and scale and scope of the tariff announcements. So we've taken down GDP growth in 2025 by roughly a percentage point to about 0.5% growth, so 0.5% GDP growth on a Q4 over Q4 basis in 2025. So we think the negative impact of the tariffs will cause price increases. So we've raised our inflation forecast and lowered our growth forecast because we do think it's going to negatively affect consumer spending and business investment as well.
So it means we have to go through the recession in future 12 months or in this year.
Yeah, it's going to feel like pretty weak growth in the U.S. And our global team has also taken down global growth as a result because of there are some retaliatory measures being put in place. We do expect that the U.S. is, which is a big source of global growth, is going to be weaker as well. And we also think this is going to negatively affect China's growth, which will weigh on some of the Asian economies like Korea. Now, I will say the outlook is highly uncertain, but even if the Trump administration pulls back on the tariffs, there's still likely to be some negative effect left due to the uncertainty and what's already been put in place. So, so the tariff policy could change a lot, but we've sort of been writing that even if they got rid of everything now, we probably would not go back up to say above 1.5% GDP growth. So we think 2025 really still is going to display a pretty meaningful slowdown compared to the very strong growth that the U.S. was experiencing in 2023 and 2024.
But as you said, U.S. job market is still strong, and I think U.S. job market has been overlooked because of tariff. Do you think strong hiring will continue in the coming months?
I think, well, we're already seeing some signs that hiring is slowing, and we'll get some more data later today in the JOLT survey, where we expect to see hiring relatively slow. We're also seeing layoff announcements rise. So we have a couple of different tabulations that we do for layoff announcements, and those have started to move up higher in the last month or two as well. So there are some signs that even though we're expecting a fine employment report to be released on Friday, that's the April data, we are seeing signs that the labor market is starting to weaken a little bit. And I think that probably continues to weaken as growth weakens. We've also seen we do some internal tracking. Our evidence lab team does some internal tracking of job openings, which have started to decline a little bit since the tariff announcements. So nothing bad yet, but we are seeing signs of slowing even in the labor market. And I think that probably continues as growth slows.
President Trump recently said he will try to reduce the impact of high auto tariff. But you mean even though he reduced the tariff, it can leave the negative effect in U.S. economy, right?
Yes. Well, one of the things the administration's trying to do is a number of the tariff policies overlap other tariff policies.
Yes, right.
So one of the things that they're trying to do at the moment, it appears, is to make sure things aren't being double tariffed. So, for example, they're providing some clarification on the auto tariffs that they're not going to be, say, in addition to 10% minimum tariffs. Based on their communications, we're still waiting to get the Federal Register notice, the official notice. But based on their communications, they're still going to continue to apply tariffs to autos and auto parts. But they are trying to be careful about making sure that different types of inputs aren't being double tariffed. Now, you can see that in other actions as well. So, they had exemptions for chips and semiconductor imports. They've also had exemptions for pharmaceutical imports. Even though they've created exemptions for those products, one of the reasons is they're considering tariffs on those products under separate authorities. So they don't want to make so that what they don't want to do is they don't want to appear to do is have double tariffs. But they still are and still seem to be trying to apply tariffs to a pretty wide range of imports across a pretty wide range of U.S. trading partners.
Just in my sense, even Trump administration are confused how they impose the what tariff or another tariff. They looks confused. Is it right or is it kind of strategy?
I mean, I don't know specifically what their strategy is. They have discussed a few goals. Some of this could be part of a negotiation over over the trade deficits, and particularly the good trades deficits. And the administration has made, no secret that they are concerned about these persistent, bilateral trade deficits. They also have been pretty clear that they want to level the playing field for U.S. manufacturing workers, where they are concerned that unfair trade practices by some trading partners have negatively affected U.S. manufacturing jobs. And I also generally think that they are trying to sort of a general policy outlook. It does appear that they are trying to promote domestic manufacturing in the U.S. more generally, and that could come with or be a reason for. I think the administration they do appear to have a few goals here. It does seem like they want to reduce the bilateral goods trade deficit. It also appears that they think some of the unfair trade practices amongst some partners have negatively affected U.S. manufacturing, and they seem to want to address that. And then, as a general policy goal, they do seem to want to promote U.S. manufacturing more generally, right? And increase the manufacturing base here in the U.S., have a stronger industrial base here in the U.S. And I think the part of the rationale for protectionist policies may be to improve the standing of U.S. manufacturing and increase its share of GDP. But we'll have to see. I mean, the president and the administration have a number of people working on trade policy. I'm sure there are different aspects of each negotiation. Some might be unfair trade practices. They've already talked about some of it could be related to, say fentanyl. So the administration has had a number of different priorities that they've discussed. But I think generally, as a policy goal, I think one of them does seem to be to improve U.S. manufacturing and bolster and expand the U.S. manufacturing base.
In the long run, do you think the tariff could actually make the U.S. economy stronger? Do you think they could help bring more jobs back to the U.S.?
I don't know. I mean, that's an open question. I mean, the administration seems to think that, I'm kind of a classically trained economist where, comparative advantage and some of the gains from trade can be a net plus. We also have to remember that things like automation and productivity growth play a big role in long run manufacturing, right? So we could imagine that, even if the US does produce more, that it produces more, but it uses more robotics, and maybe doesn't create as many actual jobs as expected. But the other thing is, we've spent a long time, going through a period of globalization, expanding supply chains. And, if we thought about it, we probably wouldn't import if it was more expensive than doing something domestically, right? We probably wouldn't import if it was inefficient or less efficient, right? So to the extent that we're going to, rip up the supply chains or try to move production back to the US, at least in the short run, it probably is a growth headwind, probably negative for efficiency and productivity, and probably somewhat, at least temporarily, inflationary. So I think on the long run, I think it remains to be seen. The administration does seem to want, a vision of the U.S. where there's a healthier manufacturing sector. They also they articulate that they think will be positive for the middle class, positive for U.S. society. But I think when I look at it, in sort of purely economic terms in the short run, the adjustment could be painful in some ways because, we've spent, decades building up these supply chains. So undoing some of them, I think probably will be a growth headwind, at least in the near term.
How about move to the China? China seems much better prepared for trade tensions than during Trump won. So how do you think the U.S.-China trade conflict will develop this time? They endure very well this time.
The tariffs on China are so large that it would imply decoupling. Coming into this year, we thought that the administration would place rather large tariffs on China. I mean, China is a little unique amongst these relationships because it's not just there are tensions over the trading relationship, but there's also there's a geopolitical element to the U.S.-China relations as sort of two large powers that is a little bit different than a lot of these other relationships we're discussing. I don't know what the end game looks like, but I do think this level of tariffs would imply that the U.S. is seeking to redirect trade elsewhere and away from China. I mean, we've certainly heard rhetoric along those lines out of administration officials, but also from members of Congress. I mean, there is a certain amount of, support domestically to reorient U.S. trade away from China. And certainly the high levels of tariffs being applied to imports from China certainly would be an indication that the administration is trying to really in a structural way change this relationship, at least for the trading relationship.
Many people are worrying about that if U.S. government imposed a huge tariff to China, it must be inflationary in U.S. economy. So next FOMC meeting is coming up soon. So how much do you think the tariff will push up inflation in the U.S.?
So, I mean, we've added almost 2 percentage points to our inflation forecasts due to the tariffs. So we do think that tariffs as a whole will push up inflation. Now, if the tariffs were contained to just China, they would be much less inflationary because it makes it easier for consumers to substitute away to other types of inputs. Production can shift. There's alternative suppliers from other than China for a lot of imports. But the way the tariffs are being applied, we think it's going to be a meaningful impact on prices in the U.S. I mean, that's an estimate. It's an open question. The administration is arguing less, but just looking at the scope of what's being proposed for tariffs, we would guess it's a pretty big price increase. Now, for the FOMC in the meeting next week, I mean, they won't have updated projections, but Chair Powell was pretty clear in his remarks 2 weeks ago that the tariffs that are being proposed are much larger than what they had in mind, and that it does create a tension for the FOMC and how to weigh their employment versus the inflation mandate, because the tariffs could be very damaging to employment. But at the same time, the Fed will need to worry about inflation and whether or not the impact of the tariffs is somehow persistent and raises inflation more than expected or raises inflation expectations. So it's a tough spot for the FOMC. You know, we won't know next week what the change in their projections are. But I mean, Chair Powell has already sort of indicated that, you know, the inflationary impacts are probably much worse than they had been thinking.
And some people said a few weeks ago the bond vigilantes came back. How would you describe how investors are feeling about U.S. Treasury right now?
So upon the announcement of the tariffs, the dollar weakened, which isn't what most people expected. Most people would have expected that the higher than anticipated tariffs would have lifted the level of the dollar. And then sort of following that, we watched a sell-off in the Treasury market. I mean, that would all be consistent with global investors being less confident in the growth outlook for the U.S. Now, in terms of the bond vigilantes, we've seen some inklings of the return of the bond vigilantes even before the tariffs. I mean, in 2023, we were sort of watching term premium rise as coupon auctions were going up because it looked like the size and increase in the deficit that sort of followed COVID was really increasing the supply of U.S. bonds to the market, and there seemed to be a little bit of indigestion in terms of like how much U.S. government debt the market wanted to absorb at that time. So we have been seeing these sort of little examples of, you know, the size of U.S. deficit starting to matter on the margin. I mean, since then, you know, we have had a little bit of a rally in the Treasury market as the growth outlook has come down and people have sort of priced in some more rate cuts. So, but, you know, I mean, the U.S. does have a pretty poor fiscal outlook, and we've got, I mean, we're expecting increases in debt to GDP, 6-7% of GDP deficits in the coming years, depending upon the policy mix. It's a lot of debt, and you know we're already basically at 100% of debt to GDP. There's really no signs that it's going to be put on a sustainable path. So we'll have to see, but yeah, it does look like on the margins, the size of U.S. deficits and the amount of debt outstanding is starting to have some impact on bond prices.
But if there is a problem about U.S. deficit or Treasury bond, but there is no arguing, U.S. Treasury bond is still a safe haven.
Yeah, I mean it's still a safe haven. I think one of the interesting things was the sell-off following the tariff announcement, because normally if there are global growth concerns, everybody flocks to treasuries. But this was clearly a time when global growth concerns were rising, but everyone was sort of fleeing from treasuries. And I think that's because the growth concerns were sort of emanating from the United States itself. Yeah, as much as people might question the role of treasuries, the dollar as a reserve currency, the world is kind of awash in dollars. A lot of global trade is still denominated in dollars. Best place to house dollars in a yielding asset is a treasury bond, or the safest. So, you know, there is sort of that aspect to treasuries that remains.
And recently, people are talking about U.S. exceptionalism less than before in the stock market. And stocks have been weaker than before, not just weak. So what is your outlook for U.S. stocks for the rest of the year?
Yeah, I mean, you know, so our strategists have a 5,300 S&P target. So that's basically kind of bouncing sideways. Now, I would note that our wealth management division has a more optimistic price target. But we're all sort of feeling our way through the through the current policies, trying to gain some clarity. I don't know if we're going to get that clarity. It would sort of help if we did. But, you know, as long as the tariffs are going to look like they're even close to as large as what's been proposed, you know, our guess is, you know, equities are probably, you know, they may not sell off a lot from here, but they're probably going to struggle in that kind of environment of of high tariffs and policy uncertainty.
Many global investors, including Korean investors, have a lot of money in the Magnificent Seven. How would you suggest they adjust their portfolio from here?
So I don't have a good answer to that because I'm not really the
Mhm.
portfolio strategist,
Mhm.
but I will
Mhm.
say they're
Mhm.
not alone, right? I mean, I think one of the challenges that the U.S. risks facing is that
Mhm.
we have a net international investment position. So that's
Mhm.
the value of what U.S. residents hold abroad versus
Mhm.
what the value of foreigners hold in the
Mhm.
U.S. of negative 24 trillion, right? So
Mhm.
so there's been significant foreign inflows into
Mhm.
U.S. capital markets over the last
Mhm.
few decades. I think it's an important question we should ask is, there's a risk to making the U.S. less hospitable to global investment. The US has benefited a lot from the buildup and the capital inflows. We need to make sure that, or we should be trying to make sure that we remain a positive destination for global investors. I'm not going to give anybody investment
Mhm.
advice in this interview.
Yeah.
And if you looked at my 401k, you would know why. But I will say these are important questions to be asking given the policy changes being put in place, because just from a macroeconomic standpoint, any economy should want to make itself, sort of a positive place for investment and growth and stability.
Mhm.
So I think that's an important thing to keep in mind as we think about U.S. policy going forward.
What is the biggest risk in these days, including tariff?
I think it is a big risk if global investors really start to flee the U.S., right? I mean, if the uncertainty, if the instability, if the tariffs, if the deglobalization really risks turning these decades of capital inflows into capital outflows, that creates a couple of problems. One, it'll depress U.S. equity markets and U.S. wealth. And second, it'll remove potentially the marginal buyers for U.S. Treasury bonds. One of the risks the U.S. faces is that we have substantial financing needs for the federal government. I mean, if those yields are going to start to rise, like, 50, 100 basis points structurally, that's going to increase the share of our deficit that needs to go to pay net interest payments on the existing debt. We could end up with significant fiscal pressure as well. Global investors are going to start to flee U.S. markets and U.S. assets. So if I think about sort of tail risk scenarios here, I mean, that's one it's not a base case at all, but I mean, it's something worth keeping an eye on.
And you are an experienced economist, and you has been through a lot of economic event, which was affected by political or geopolitical situations. So if you advise to someone who sit on the table with the Trump administration, what is your advice?
Well, they're not actually asking me for my advice. And, ever since the GFC, I think economists have been asked less and less for advice. But, when I think about what's good for long run growth, it's, can we have a stable tax policy that promotes investment and puts us on a sustainable long run fiscal trajectory? When I think about, domestic incentives, I do think there's benefits to globalization and trade. I mean, when I think about things like, the administration would like to have, more protection for copper, but we have allies also that produce a lot of copper in Chile and Canada. I mean, we could coordinate and cooperate along a number of lines. So when I think about, how, a traditional economist would provide advice, it's yes, we want to make sure that we're a stable and attractive place for investment to boost productivity growth. And I do think that, globalization can be part of that, as opposed to swinging the pendulum, say too far towards protectionism.
Thank you so much for your time.
Thank you very much.